The recovery in business sentiment has stalled. Following 3 consecutive increases, the RMBBR Business Confidence Index remained unchanged at 45 index points in the first quarter. 4 of the 5 sectors saw confidence slip, but this was offset by a significant improvement in the outlook of new vehicle dealers. Respondents noted strained US-SA trade relations as a concern, as well as ArcelorMittal's potential closure. The majority of responses were received prior to the delay in the tabling of the national budget. South Africa's private sector remained under pressure in February. That's as business conditions deteriorated for a 3rd consecutive month. The latest S&P Global SA Purchasing Managers Index came in at 49 points. This is below the neutral 50 market that indicates conditions are worsening overall, but it is an improvement on the previous month's reading of 47.4, and so the data suggests that the rate of deterioration has at least eased. In company news, Curro's report card for 2024 is out. South Africa's largest independent school operator has delivered a 13.4% increase in annual headline earnings per share. This was helped by a 7% increase in tuition fee revenue, but the group's student numbers stagnated during the period, showing that pressure on South African households remain. A final dividend of 16.6 cents has been declared. This is 13% higher than the previous period's payout. Woolworths has posted a near 25% drop in half-year headline earnings per share. That's after a lower contribution from the retailer's apparel business outweighed the stronger showing from its food division. An interim dividend of 107 cents per share has been declared. That's 27.7% lower than a year ago. Looking ahead, Woolworths says while there have been signs of improving consumer confidence in South Africa and Australia, the recent positions taken by the US on global trade relations has elevated the forecast risk for the macroeconomic outlook for this year, particularly for South Africa. The firm has also cautioned that the retail sector in Australia is likely to remain highly promotional until pressures on the cost of living ease. And the company has also announced that it will undertake a reassessment of the carrying value of the assets of its underperforming brands within the Country Road Group during the second half. Building retailers are still under pressure. That's according to Cashbuild. The sector had hoped that the implementation of the two-pot retirement system, interest rate cuts and lower inflation would have brought some relief, but this has not materialized. Nevertheless, Cashbuild says it has delivered a stable financial performance for the 6 months to end December. Revenue ticked up 5%. This helped lift headline earnings per share 4%. An interim dividend of R3.26 has been declared. This is unchanged from the previous period's payout. Quilter has beat estimates with a 17% rise in profit for 2024. That's as the British wealth manager enjoyed a year of strong cash flows from its high net worth clients. Alongside the results release, the group also announced that an ongoing review will cost the company £76 million. Quilter has been reviewing its historical services provided to customers amid heightened regulatory scrutiny of charging by fund managers. It's the first time that the business has quantified the remedial costs related to that review. Spur has served up higher profits. The restaurant group has posted a near 12% rise in half-year headline earnings per share. That's even as consumers remain under pressure. The owner of Rocco Mama says the firm's distinct value proposition that attracts customers. An interim dividend of 106 cents has been declared. That's up 11.6% on a year ago. Looking ahead, Spur has set its sights on growth. It plans to open 47 new restaurants in South Africa and 13 new restaurants internationally in the 2025 financial year. Old Mutual expects annual headline earnings to be as much as 30% higher. That's thanks to strong performances from Old Mutual Insure, Wealth Management and Old Mutual Investments. The financial services firm will open its books on the 18th of March. Meanwhile, Growth Point says it expects distributable income per share growth of between 3 and 4% for the 6 months to end December. And given this outlook, the property group has increased its full-year guidance for distributable income per share growth to between 1 and 3%. Further detail will be provided on the 12th of March when the company releases its interim results. And Stadio has forecast a bump in full-year earnings. The private education group expects headline earnings per share to be between 23 and 33% higher. The group gave no indication of what has supported the projected rise, but details will be published when the company releases results on the 24th of March. In international news, an investor group backed by BlackRock agreed to buy a majority stake in the Hong Kong-based company that runs ports along either side of the Panama Canal, giving a U.S. firm control of key docks amid pressure from the White House to take them from China. Here's more detail in this report.
Giant U.S. asset manager BlackRock is backing a takeover of Panama Canal ports operated by Hong Kong firm CK Hutchison. The deal announced is valued at $22.8 billion and also includes dozens of ports in other countries. It appears to be a win for U.S. President Donald Trump's aggressive diplomacy. He has vowed to wrest control of the canal, falsely claiming that it is being run by China.
China's involved with the Panama Canal. They won't be for long.
Trump has cited the presence of Chinese companies as evidence, with Washington pointing to CK Hutchison's role as a security risk. The US president has refused to rule out military action over the matter. Now the new deal will give the BlackRock-led consortium a 90% stake in Panama Ports Company, which has operated ports on the canal for more than 20 years. A Reuters source says BlackRock, the world's largest asset management firm, has briefed the White House on the move. One expert called the sale a huge win for the US and said it should calm tensions over the canal. Last month, Secretary of State Marco Rubio visited the area and pressured Panama's government to limit Chinese influence. The country subsequently said it would review CK Hutchison's port contract and exit China's Belt and Road infrastructure project. Now the deal could also temper Republican criticism of BlackRock and its boss, Larry Fink. They have been under fire for embracing environmental, social and governance factors in investing.
And Adidas sold its last remaining pair of Yeezy sneakers in the fourth quarter, ending the process of liquidating stock of the lucrative shoe line developed with rapper Kanye West. The move has left with a big hole to fill in the US. Let's take a look.
Adidas has put one big controversy behind it. The sportswear giant says it sold the last pair of Yeezy sneakers in the fourth quarter. It had developed the brand with rapper Ye, formerly known as Kanye West. The partnership became hugely profitable but had to be ditched after anti-Semitic rants by the singer. Adidas has since sold off its stock of Yeezy shoes, donating some of the proceeds to organisations fighting discrimination. The move has left it with a big hole to fill in the US, where the rapper's brand was very popular. The German firm is far from suffering overall, however. Worldwide, it saw growth of 12% last year, with some regions doing even better of late. In Latin America, sales were up by close to a third over the holiday quarter, while North America saw a rise of 15%. Adidas has enjoyed strong demand for retro-styled sneakers like its Samba and Gazelle lines. That has seen it gain market share in the US, capitalising on sagging sales at arch-rival Nike. Adidas now says it has the goal of being the top sportswear brand in every market outside the US. It has a new musical ally to help with that, rolling out a line of sneakers with American singer and designer Pharrell Williams. For the year ahead, it's now expecting growth to hit a high single-digit rate, still robust but slightly down on the previous 12 months. Shares in the firm fell in early trade Wednesday following that outlook.